Inheritance tax is incredibly unpopular because it's paid on money that's already had things like income tax taken off it, and it's paid at the rate of 40%, which is pretty excessive. So let's have a look in this video at ways to minimize and beat inheritance tax. The current threshold for inheritance tax is £325,000, and inheritance tax is not paid on any pension assets, which is why I recommend that pensions are withdrawn from last when you're drawing down on your wealth. There's an extra £175,000 available if you leave your main residence to your spouse or your direct offspring. Any unused inheritance tax can also be then subsequently utilised by your spouse when they die. So you can actually amalgamate all the inheritance tax allowances. So as an example, if a husband dies, he had an estate of £600,000, he leaves £130,000 to his children, the rest to his wife. He's then got a 60% unutilised inheritance tax allowance, and that also goes to his wife, and the 60% is the 325k less 130k divided by the 325,000. So his wife's allowance is now 325,000 plus another 60% of the 325,000, making it 520,000 in total. And so you can combine these inheritance tax allowances and get a maximum relief of £1 million. So ways to avoid inheritance tax. Well, one way is to spend it as part of a carefully crafted wealth plan so you're confident you're not going to run out of money. Another thing to do is to gift the money 7 years or more before you die, but the problem is you don't know when you're going to die, so you kind of gift the money almost like as soon as you can. And again, you need a proper plan around this that you can gift with the certainty that it is kind of excess money. You're unlikely to need that money, and that way your dependents can enjoy the money earlier in their lives and more put it towards things like a house deposit rather than getting the money when they're in their 50s and they don't necessarily need it. You can beat inheritance tax by the correct drawdown of assets in retirement. If you take money from the assets that are subject to inheritance tax first, then that could be beneficial for you. So that means taking from general investment accounts and ISAs first, and then taking from any personal pensions or workplace pensions last, because they are not subject to inheritance tax. And that way you still got money in later life, but there'll be no inheritance tax bill on it, and the only thing potentially liable to inheritance tax will be your property. And then to get around paying inheritance tax on your property, you can undertake equity release 7 years or more before you die, and then with the equity release money you can either gift that to your children or you can spend it, and you can leave enough money within your property to fund any potential care costs. And this way you've reduced the net value of your property, although you're still living in it and you still control that asset. Another thing you could do is buy an annuity. Annuity rates get better the older you get, because when you die, the annuity company is the winner that takes it all. So that is a possible way of reducing your wealth in later life, but then still having an income that comes in. And this can be linked to aggressive spending in retirement, because what you can do is spend down your assets, but then when they hit quite a low threshold and you are more at risk of running out of money, you then just switch over to an annuity that then just augments your pension, and you've got a decent income for the later phase of your life. The options of equity release and an annuity do need professional advice to make sure that it is correct for you and your circumstances. One thing I'd be very careful about is putting assets into a trust. This can be very expensive, very complicated, and more the HMRC is looking through these trust arrangements and seeing them as pure tax avoidance and ruling that inheritance tax is to be paid. Another one is life insurance or life assurance policies. With these policies, the premiums can escalate over time and you can end up putting more money into them than they actually pay out. So they can become completely pointless if you live to a ripe old age. So what now happens is that what you thought about saving for the future was actually incorrect. The goal is not to have so much money that you can never run out. Instead, it's to enjoy life to the full and to do the enjoyable experiences pretty much as early as you can so that you can tick them off and you can look back on your life and think of all the amazing things that you've done before it was too late. And that's what the book Die with Zero by Bill Perkins is based on. It's challenging people to rethink the wisdom of having lots of money and instead to maximize your life experiences. So the ways to potentially lower the inheritance tax bill would be to gift money early in our lives as part of a carefully thought out wealth plan to make sure we can afford it, to look at the order of drawdown of assets such that we take from pension last because there's no AHT on that. Then we can look at potentially equity release on our property when we're older so that will put a debt against the property which can be offset against an inheritance tax bill. And finally, we could consider buying an annuity in later life, and that will convert wealth into an income stream. And the last two options are better off discussed with some sort of advisor. By having a wealth plan and a glide path for our wealth in retirement, we can safely spend money without excessively worrying about running out of cash. And unlike the book, Die with Zero, we could just die with a zero inheritance tax liability because the assets we'd have left at the end of our lives would most likely be a pension and not subject to any IHT. So if wealth planning and a retirement calculator interests you, go to my website ianshadrack.com and I'll put a link in the description. If you want to learn a bit more, then check out this next video.